Hello. Hello. Hello everyone. How are you all? Yes, I hope everyone is fine. I'm also very fine. Now, so we are here for paper 6A of CA final. Paper 6 is an elective paper and paper 6E is global financial reporting standard. Global financial reporting standard. I hope everyone know that all the subject which are given in elective paper is based on core paper. So this global financial reporting standard is totally based on our core paper, that is paper 1 financial reporting. You can see global financial reporting standard is based on paper 1 financial reporting. Already you have done the coaching of financial reporting. You might have also written exam for group 1, or you might be writing both group together. Means one thing is clear, that before learning this subject you should have knowledge of paper 1 financial reporting. It means if you have not done paper 1 financial reporting, it will be not, means you will not be able to understand global financial reporting standard. Of course, it is understood that if you have joined for global financial reporting standard, you have done paper 1. Now one doubt will come, sir, we have done the coaching of paper 1 financial reporting some year before. Means it might happen you have done 2 year before and now you are taking coaching of paper 6C global financial reporting standard. So it might happen कि whatever you have learned or understood in financial reporting paper, that you have forgotten. Means still now you have not done the revision of financial reporting. So one thing is clear, that before starting this paper you should have a revision of financial reporting paper. Even though you have written your group 1 exam and even though you passed group 1 exam, am I clear whatever I am saying? Yes sir. So what actually financial reporting paper consists of and what actually will be doing in this paper, first I need to explain that. Means when we say paper 1, everyone just try to understand. Paper 1 compared with paper 6C. Paper 6C. Correct. Now paper 1 consists of Ind AS. Correct. And also there were many appendix to Ind AS. For example, if I say Ind AS 103, when you have done Ind AS 103, you have done one appendix C to Ind AS 103. Correct now. When you have done Ind AS 10, you have done one appendix A to Ind AS 10, if you remember. Correct now. It means with Ind AS we have also appendix to Ind AS, correct? But in paper 1, there were some appendix which were not in the syllabus. For example, there was some appendix related to Ind AS 37. Ind AS 37 means provision, contingent liabilities, and contingent asset that were intentionally removed from the syllabus of what? Paper 1 by ICI. Correct? And there were some appendix, even though they were in the syllabus but not important from examination point of view. So it might happen your faculty has not done that appendix in FR paper because that is not relevant from examination point of view, or it was very basic appendix. So it might happen ki your faculty has given the concept behind that without referring appendix. Are you able to understand? Yes, sir. But paper 1 consists of Ind AS, an appendix to Ind AS, and there were two more chapter. One is CSR based on guidance note, correct? And there is one chapter integrated integrated reporting. I hope you have understood. This was the paper 1. Now when I am coming to paper 6E, the name is Global Financial Reporting Standard. Means when I say financial reporting, the financial reporting paper deals with the financial statement as per India is concerned. Means how to prepare financial statement for a company which is reporting as per Indian Companies Act. Are you able to understand? Yes, sir. But when I say global financial reporting standard, means we need to now understand how financial statements are prepared in global market. Global market means any companies which are outside India, incorporated outside India, they prepare financial statement based on which standard. So I hope you all know that internationally for Ind AS means as compared to Ind AS, we have what? International Accounting Standard and IFRS, correct? IS and IFRS. However, you all know that Ind AS is nothing but converged form of International Accounting Standard and International Financial Reporting Standard. Means International Accounting Standard before 2001 was known as International Accounting Standard. After 2001 was known as International Financial Reporting Standard. Correct? And this appendix, which has been added to various Indias, this is nothing but various interpretation given by either SIC, SIC or IFRIC, IF, IFRIC interpretations. Interpretation. SIC means what? Standard Interpretation Committee. IFRIC means what? International Financial Reporting Interpretation Committee. So same thing before 2001, there was Standard Interpretation Committee. After 2001, the name was changed to IFRIC. IFRIC means International Financial Reporting International Financial Reporting Interpretation Committee. If you want to write down, write down. SIC means what? Standard Interpretations Committee, and IFRIC stands for International Financial Reporting Financial Reporting Interpretations Committee. Understood? The same what I have said for IAS. IAS was before 2001, means any standard issued before 2001, it was known as International Accounting Standard. Correct? That you might be knowing. Before 2001 and IFRS is after 2001. Similarly, SEEK is what? Before 2001 and International Financial Reporting Interpretation Committee is after 2001. Now, what is their purpose? These SEEK and IFRIC interpretations means SEEK and IFRIC. Whenever there is a guidance required for any accounting treatment for which accounting policies are not given in IAS or IFRS, so they will give their interpretation for that. Means any new development for which there is no accounting treatment given under IAS or IFRS, so this committee will give an interpretation for that. And this SEEK and IFRIC will become appendix to Ind AS. Means can I say this Ind AS is nothing but, I will say, not totally same as IAS or IFRS, but similar to, I will say similar to IAS and IFRS. Only there are 7 to 8 difference. If you do that difference, correct, conceptual difference, then you can I say Ind AS and IFRS will become same. Correct. And appendix to Ind AS and SIG, these are totally same. I will say same to same. Correct. Now there are some interpretations, which you might, which you have not done. Yeah, you have not, you have done, but you are not knowing that that were appendix part in your financial reporting. So we need to go through that also. Yes, sir. Correct. Means can I say as per Ind AS and appendix to Ind AS, if you do the difference between Ind AS and IFRS, automatically you'll cover the syllabus of global financial reporting standard. Correct now, because Ind AS part which is common remain common. I hope you're understanding. So for these, as per syllabus is concerned, as per syllabus is concerned, can I say first we need to do difference between Ind AS and IFRS. Now, whenever I say IFRS, IFRS will include IAS also, correct? Yes, sir. And of course, we need to also do what? Interpretation given by SEEK and IFRIC. Yes, sir. So we need to do SEEK oblique IFRIC interpretations, correct? But out of that also many appendix, means many appendix to Ind AS already covered in your financial reporting paper. Are you able to understand? Yes, sir. Correct. And this two chapters, CSR and integrated reporting, that will not be covered in your paper 6C. Correct? Yes, sir. So can I say, if as per paper 6C is concerned, paper 6C global financial reporting standard, if you do the difference between Ind AS and IFRS and you have knowledge about the interpretation given by SIC and IFRIC, then the paper is over. And this will not take more than 1 hour. Correct? And this will take some point, but out of this SIC and IFRIC interpretation, till now only one question have been asked from that interpretation. Now from examination point of view, whether this seek and ifric interpretation are important or not important, that will be based on the paper, whether they are asking question on that or not. But we'll cover it totally. But out of that also many interpretation is already covered, correct? Yes, sir. Now, apart from these two, there is one more part which we need to understand. That is difference between IFRS and US GAAP. You might be knowing about the US GAAP. US is the country, means US country has not adopted IFRS. Till now, they have not adopted IFRS. So they are preparing their financial statement based on US GAAP. Means any companies which are listed in US stock exchange, they need to also prepare their financial statement based on US GAAP. And US GAAP and IFRS are also different. They have some different accounting treatment. Means we need to also understand what is the difference between IFRS versus US GAAP. Correct? Now, from examination point of view, means from paper 6C point of view, paper 6C, they will ask 90% question from IFRS based, means the IFRS based question. When I am saying IFRS, it will include the interpretations also. It will also include IES. And they may ask 10% question from US GAAP. Means from examination point of view, if you are not doing US GAAP also, 90% syllabus is covered. 90% syllabus is covered. Correct. So this US gap I will do at the end of the entire syllabus as a separate topic, so that you have first knowledge about the question pattern, you have a confidence about this paper, then we'll come to US gap. Are you able to understand? Yes, sir. So this US gap will be done in the class at the end of the syllabus. Correct? Now, this I have IFRIC interpretation I will not do immediately. Means I will not start reading IFRIC or doing giving explanation of IFRIC. I will take all the IFRIC, but whenever required, whenever required. Suppose one case study we are doing. In that case study, they have asked question from a particular IFRIC. So first I will explain the IFRIC interpretations, then I will do the case study. Correct? And the balance IFRIC from which till now no question have been asked, I will do whenever I feel that it should be done. Correct? Understood. Now question about this difference. Today only I will start the difference between Ind AS and IFRS. Means today I will start with the difference between Ind AS and IFRS. But one doubt is coming, sir. What about paper 1 financial reporting? It might happen you have forgotten. Correct. So for the part which is common between Ind AS and IFRS, which is common between Ind AS and IFRS, correct, we will do a revision of that, but will not take revision in our class. Already I think you have got the revision video for paper 1 FR. Correct now. So for this, what I will do, I will give you given, what will be given, revision video for for FR paper. Correct, revision video for FR paper. So it will be given as a Google Drive link in your mail ID. Whenever you feel that you want to revise a particular chapter, you can revise from that. So it will, the revision of it will help in two ways. This will help you for paper 1 also, and this will help you for paper 6C also. So that revision will help you in two ways. Even though if you have done paper 1 either from me or from some other faculty and you have written the exam, then also this video, if you feel that it need to be done, you should do it. Correct? Understood? Yes, sir. Sir, if you do not, if suppose you do not have the time for revising this FR paper video, then what need to be done? So what I will do, whenever I will take any case studies, any important concept behind that which I feel that the revision is required, so I will revise that particular topic in class only. Don't worry about that. I hope you have understood. Correct? Have you understood? Yes, sir. Correct? Give me 1 minute. Hello. Is it audible? Everyone? Yes, sir. Okay. Now, have you understood the syllabus part? So can I conclude once again? As per syllabus is concerned, point number A, we do the difference between Ind AS and what? IFRS? Correct. For that, revision video will be provided for for you can add them for Ind AS. Correct? Yes, sir. For Ind AS means for the common part. Difference part will do in this class only. Correct? Yes, sir. We need to also cover the interpretation given by Sikh and Ifric interpretation. Means this, even though you have done in your FR paper, I'll cover all the interpretation given by Sikh and Ifric. Correct? Now, even though you have done in your FR paper, yes, sir. Then we need to cover difference between what IFRS. When I say IFRS, IFRS will also include IAS as well as interpretation. Correct? And US gap. Yes, sir. This is the part of syllabus. Correct? If you want to go through, the syllabus given by institute. You can see ICI has given syllabus for final elective paper 6C Global Financial Reporting Standard. Correct? What they have written? In respect of final elective paper 6C GFRS, students are advised to read module 1 to module 4 except chapter number 16 and chapter number 17. Correct? This chapter number 16 and 17 are nothing but CSR and integrated reporting. Correct? Of final paper 1 financial reporting. Understood? Reference of Ind AS material has been given because Ind AS along with difference to Ind AS in relation to IFRS is equivalent to IFRS. Means if you have done Ind AS and the difference between Ind AS in relation to IFRS, the syllabus of GFRS paper is automatically covered. Understood? It means, can I say, because it is an open book exam, so which book you need to carry? Which book you need to carry? That you need to understand. The book is very important. Are you able to understand what I am saying? Write down second point about books. Which book is relevant? Correct. Means, can I say, first, study material for paper 1 given by ICI. Correct. So there is module 1 to module 4. Module 1 to module 4. Correct. Instead of this, you can carry the Ind AS Saransh book. Ind AS Saransh book, which is given by me. So I am also giving Ind AS Saransh book, even though if you are taking GFRS paper, means this Ind AS Saransh book is for paper 1 financial reporting, which will be also useful for paper 6C. I hope you are understanding. So instead of this, you can also carry Ind AS Saransh book. Correct? So as compared to module given by ICI, this will be a saransh of that. Means it will be given in simple wordings. Correct? And it will be a brief wordings, brief of entire Ind AS. Correct? Yes, sir. Then point number two, you need to also carry the two module 1 and module 2 of case study given by me, given by CJ sir. Correct? This will include all the case study which has been this will include all the case study which has been given by ICI in ICI study material, revision test paper, model test paper, and in exam. I hope you understood. So this module 1 and 2 will include all the case study which has been given by institute, as well as it will also include difference between Ind AS and IFRS. It will also include difference between difference between what? IFRS and US GAAP. Correct? The interpretation will be given to you soon as a PDF. So I am just summarizing all the interpretation from examination point of view so that it will be easy for the revision purpose and for your exam purpose. So you need to give me some time. I am drafting interpretation in a simple word so that you can use that interpretation in a quick as a quick reference in your exam. I hope you are understanding, correct? So this module 1 and 2 which is given by me right now does not include the interpretation given by Sikh and Ifrik. Understood? Yes, sir. Correct. So how many interpretations are there? If you want to check, these are the interpretation. You can see Ifrik 1, Ifrik 2. So there are how many interpretations? There are 20 interpretations. Out of these 20 interpretations, two interpretations are not relevant from examination point of view. You can see I have already written Ifrik 2 is not relevant and Ifrik 7 is not relevant. Correct? Understood? And you can see out of these 20, you can see this has been already covered, means it is covered under India 16 changes in existing decommissioning restoration similar liability. I hope you know about this. Correct? Understood? Changes. This I hope you have covered. This is also covered in your FR paper. If not covered, I will do. Don't worry. Correct now. This is also covered. This service concession arrangement. This is also covered. Correct. I hope IFRIC 16 has not been covered because they have not given any question based on hedge accounting. So normally teacher don't teach hedge accounting. Even though they are teaching hedge accounting, they will not teach this IFRIC. And even though you have done, thank you very much. But I will do that IFRIC in class. Correct now. But IFRIC 17 has been done. I hope. If not done, don't worry. Correct. Then this IFRIC 19 has been covered. This is extinguishment of financial liability and equity instrument based on Ind AS 109. Then this IFRIC 22 has been covered. I hope. Then this SIC 10 has been covered. Then this SIC 29 is automatically covered because this is also based on service concession arrangement. Correct? So these are already covered. Balance, it might happen not covered, so that will do it. Don't worry, all the IFRICs will be covered in class. Even though if you have done in your FR paper. Understood? I hope you have understood. Correct? Yes, sir. So as per books you have understood which book you need to carry in exam, which book you need to carry in exam. So you can carry all the study material for paper 1 which has been given by ICI. Instead of that, you can also carry my India Saransh book. That will be handy to carry and you can also easily refer that. Correct. Then you need to also carry module 1 and module 2 of case study given by me. These two will cover all the parts. Correct. Then you can write down point number 3. You should also carry seek and IFRIC interpretations. Understood? Yes, sir, we have understood. Books you have understood? Yes, sir. Now, third point, question paper. So, what will be the pattern of question paper? So, initially, they used to ask 3 case study of 50 marks each. And out of that 3 case study, 2 case study need to be done in 4 hours. I hope. So, hours given is 4 hours in the exam. They will give how many? They initially they used to give how many case study? 3 case study of how many marks? 50 marks. Out of 3 case study, we need to do 2 case study in exam. But now the pattern has been changed. Now they will give how many case study? 5 case study. Out of that, 4 case study, 4 case study, 5 case study of 25 marks each. Means it become 125 marks. Correct. Out of this 5 case study, any 4 case study is required to be solved in exam. Now this case study will be based on, I will say, real-time examples. Means they will give a case study, uh, assuming that this one company and these are the points for which you need to give your what answers. Ki what will be done if you are an auditor of that company? I hope you are understanding. Yes, sir. If you are auditor or consultant of that company, yes, sir. Now in this four case study, this will be divided in two part. They will ask descriptive questions and objective question. Correct? Objective question they will ask for each case study. They will ask question, five question. Yeah, I should write down five MCQs of 2 marks. Correct? Means can I say it become 10 marks each case study, 10 marks per case study, and if there are four case study, so can I say it become what 40 marks, 40 marks. And I will say this is so if you have some knowledge about FI paper, then you can easily score 40 out of 40. You can easily score because this will be MCQ based question. It will be very easy. Means in every case study you'll find that MCQ is very much easy to score. So I will say out of this 40, you can easily score 40 marks. You can easily score 40 marks. But for this objective, because they have given 2 marks, so you need to also give reason even though they have not asked reasons. Correct now? So for these MCQs you need to always give reasoning even if even if not required, even if not required. Correct? That means even though not specified, better write down not required, not even if not specified in question. Have you understood? So this 40 marks will be very easy to score. It will be proved when we will take case studies. So how many case study they will ask? They will give 5 case studies of 25 marks each. For that we need to only give solution for 4 case study. In 4 case study, they will give for 1 case study they will give 5 MCQs, means 10 marks MCQs, so it become 40 marks. Correct? And the descriptive questions will be either they will ask 2 questions or 3 questions per case study. Correct? Now it will depend upon the case study. So I am writing they will ask 3 questions, 2 or 3 questions. They will ask 2 or 3 questions of how many marks? 15 marks. So 15 into 4, it comes 60. It is what? Equal to 60 marks. Ha. For these 15 marks question, a descriptive question, you should have a thorough knowledge of FR paper. If you have thorough knowledge of FR paper with difference, it is very easy. It is also very easy from examination point of view. But in this you need to have a writing skills also. Ki how to write this type of answer. Correct? Understood? Means this will be a practical based questions. Practical based question where you need to prepare either consolidated statement or whatever they ask in exam. Yes, sir. Correct? Yes, sir. Have you understood? Yes, sir. So this is the pattern of question paper. So I have said that initially they used to give a case study of 50 marks. So what I have done, the all the case study of ICI study material which were of 50 marks, I have divided into 2 case study of 25 marks each. Correct? Now as per the requirement of new pattern of question paper. I hope you are understanding. So please don't compare this case study with the ICI case study. It might happen the ICI case study was of 50 marks which I have split into 2 parts, so that you can understand what is the requirement of current ICR pattern of question paper. I hope you understood. Yes, sir. Correct. So already I have divided, means whatever case study you have got right now in my study material, that is of 25 marks, not for 50 marks, correct? Yes, sir. And there are many changes also. For example, India 17 has been changed to India 116, means I can say India 17 means what? IAS 17 has been changed to IFRS 16. So all the question also I have changed. The question I have changed as per the requirement of new IFRS or IAS. Yes, sir. Yes, sir. Correct. Question paper you have understood? Yes, sir. Then add on. Point number four. Point number four. About doubts. Doubt will not come, but if it is there is some doubt in your mind, so if you are taking my live classes, then you can ask doubt immediately in the chat box. And if you want to ask doubt after class, then I will give you one Telegram link. You can ask doubt there. Of course, the Telegram link will be provided via email. If you have purchased my Google Drive classes, then also Telegram link will be given. You can ask all doubt related to this chapter, related to this subject in that Telegram group. Correct now. So for doubt, I am writing Telegram link will be provided. Telegram group link will be provided via email. Yes, sir. We have understood. Mode of class will be what? Totally English. It will be English. The lectures will be in English. I hope in this there should not be any doubt. Correct? Yes, sir. Any more query you have in your mind about this paper, you can ask me right now. Otherwise, we'll start the subject. Any doubt? No doubt? So can we start with the subject? Yes, sir, we can start. Have you written all these things? Because this will be required. Ki what you need to do for this paper. I hope you have written. Yes, sir. Now we'll start with what? Index versus IS and IFRS. Correct? As per the name is concerned, the name of Index and IFRS are same. Correct? If you see the name, correct now? Just try to understand. As per name is concerned, so IS1 is Ind AS 1 and the name is same, presentation of financial statement. IS2 is Ind AS 2 and the name is inventory. Correct? So there is IS1 to IS40, IS1 to IS40. So there is Ind AS 1 to Ind AS 40. And after IS40, they started issuing IFRS. So there is IFRS 1 to IFRS 17. But out of this means IFRS 1 to IFRS 17, IFRS 17 is under development. So it is not yet effective. So of course IFRS 17 is not in our syllabus. So I will say IFRS 1 to IFRS 16, which is nothing but Ind AS 101 to Ind AS 116. Correct? Yes, sir. The name is same. Now out of this IAS and IFRS, there are some IAS which is not relevant for this paper, GFRS paper. So IS 26 is not in our syllabus. IS 26 is not in our syllabus. Correct. This was accounting and reporting by retirement benefit plan. This is not in our syllabus. Correct. IS 29 is not in our syllabus, financial reporting in hyperinflationary economy. So that was not in FR paper also, correct? And you can see IS 26, there is no corresponding index. So this is not in our syllabus. Even though this is not in our syllabus of paper 6C, correct? And IS 39, this is to have been removed after introduction of IFRS 9. But then also there are some part which is relevant. So they have kept it, correct now. But there is no corresponding Ind AS you can see. So that is also not in our syllabus. Similarly, IFRS 4 Ind AS 104 insurance contract, it is not in our syllabus. Paper 1 also it is not in our syllabus. Paper 6 is also not in our syllabus. IFRS 6 Ind AS 106 exploration 4 and evaluation of mineral resources. This is also not in our syllabus of paper 1 as well as paper 6C, correct? And IFRS 14 Ind AS 114 regulatory deferred account. This is not in our syllabus of paper 1 as well as paper 6C. And IFRS 17 insurance contract, till now it is not under, means it is under formulation, means till now it is not formulated, means this is not yet effective. So of course it is not a part of syllabus, but once it become effective, once it is formulated, so of course it will be a part of the syllabus, correct? So it is under formulation. Have you understood? Correct. Similarly, IFRIC 2 is not relevant as per Ind AS is concerned. IFRIC 7, IFRIC 9, IFRIC 9, correct. 6, 7 are not relevant. It is not in our syllabus. Correct? It is not in our syllabus. I'm just giving you so that you have idea ki whether it is a part of syllabus or whether it is not a part of syllabus. Now coming to difference. Coming to the difference part. So when we say difference, there are three types of difference. There are three types of difference between Ind AS and IFRS. First is known as carve out and carve in. Carve out and carve in. It might happen in FR paper also you have done carve out and carve in. Means even though it is not a part of FR paper, but in institute study material they have mentioned carve out and carve in. So normally a teacher teach that also. For example, I have also taken carve out and carve in wherever required in FR paper. Correct now. So it might happen you have knowledge about carve out and carve in. Correct. Second difference is terminology difference. Terminology difference. This terminology difference arises due to Companies Act. Means there are many terms used under Companies Act, so the terms has been changed as compared to IFRS. For example, two terms I will say. For example, in India we say statement of profit and loss. Statement of profit and loss. But internationally, it is known as statement of comprehensive income. I hope you know this. Statement of comprehensive income. Statement of comprehensive income. So in India, the word SOPL has been retained due to Companies Act, due to Companies Act. Similarly, in India, we call balance sheet, but internationally, it is known as statement of financial position. Statement of financial position. I hope you have understood this point. Correct. So these are terminology difference, but can a terminology difference will not affect accounting policies or accounting treatment? Whenever there is a terminology difference, that will not affect the accounting treatment. Okay. Third is what? Removal of options. A removal of options. A removal of option. So as per Ind AS is concerned, there are many options which has been given under IAS and IFRS that has been removed under Ind AS. The best example I will say as Ind AS 40, Ind AS 40 says कि for investment property for subsequent recognition only cost model can be used, cost model. But as compared to IAS 40, IS-40 says investment property can be subsequently recognized either by using cost model or revaluation model. A revaluation model. I hope you have understood. So this option has been removed in India. This option has been removed in India. I hope you have understood this point. But can this option which has been removed in India will not affect the accounting treatment. Means they have removed the only options. Means internationally either you can use cost model, revaluation model. India they said only cost model. You can use only cost model for investment property. Correct? Understood. Means the major difference is what? This carve out and carving. So what is carve out and carving? That we need to understand what is carve out and carving. So just write down what is carve out. What is carve out? Means there are many accounting policies which has been adopted in India which is different from accounting treatment which is given in IAS and IFRS, and this difference is due to economic condition prevailing in India, which is different from uh, economic condition based on which IFRS has been formulated. So, giving emphasis to economic condition prevailing in India, some differences has been made as compared to the accounting treatment given in what IFRS. That difference is known as carve out. That difference is known as carve out. I hope you have understood. Write down in this changes which have been made. Changes which have been made considering the economic environment of India, which is different, which is different as compared to, which is different, which is different as compared to economic environment presumed to be presumed to be in existence by IFRS. So these deviation are known as what? Carve out. I have I hope you have understood to be in existence by IFRS. When I say IFRS, IFRS will also include IS. Correct? Yes, sir. Carve out, you understood? Yes, sir. Yes, sir. Yes, sir. What is carving? There's only one carving. There's only one carving that you have done under Ind AS 103. That is business combination under common control. Business combination under common control. So whenever additional guidance is given over and above what is given in IFRS, so additional guidance which is given in Ind AS which was not in IFRS, that is known as carving. That is known as carving, and there is only one additional guidance has been given, that is what Appendix C to Ind AS 103. Appendix C to Ind AS 103. Correct? That is business combination under common control. Right down. Additional guidance, additional guidance given in Ind AS over and above what is given in IFRS, what is given in IFRS is known as carving. Understood this point? Have you understood this part, carve out and carving? So major difference is carve out and carving. If you understand carve out and carving, so automatically your IFRS is covered with some difference which is related to terminology difference and removal of option. Of course, that we need to also do. So can we start about difference? First, we'll start with carve out and carving. It might happen this carve out and carving also you have done in FR paper. Correct? Yes, sir. Let us do. We'll start with what? Carve out and carving. 1 minute. Do you have volume 1 with you? Can you open your volume 1? Yes, sir. For GFRS paper. So can we start with carve outs? Carve outs. Understood? So first we need to understand what is given as per IFRS or IAS and what is given under Ind AS. So if you understand the difference, automatically can I say IFRS will be covered. So first difference is under Ind AS 1. Under Ind AS 1. Correct? Means already you have done under Ind AS 1. We need to understand what is given under IAS 1. We need to understand what is given under IAS 1. So let me first recall what we have done under Ind AS 1 about this point. What Ind AS 1 says? Ind AS 1 says whenever there is a breach of material provision of a long-term arrangement on or before the end of reporting period with the effect that liability become payable on demand on the reporting date. You remember this point? Ki if there is any breach of material provision, if there is any breach of material provision of a long-term arrangement on or before the reporting date with the effect that your liability become payable on demand, and whenever liability become payable on demand, so can you say it will be it will be reclassified from non-current liability to current liability? Correct? Yes, sir. The entity does not classify the liability as current. So entity will not classify the liability as current even though it is what? It is repayable in demand. When? If the lender agreed after the reporting period and before the approval of financial statement for issue not to demand payment as a consequences of breach of contract. Means what they are saying, as per Ind AS 1, as per Ind AS 1, correct? And similar point is given under Ind AS 10 also. Similar point is given under Ind AS 10. Means because of this point, same thing is given under Ind AS 10 also. Let us read what is given under Ind AS 10, what they have given. As a consequences to carve out under Ind AS 1 as stated above, Ind AS 10 provide that in the definition of event after reporting period that in case of breach of material provision of a long-term loan arrangement on or before the end of reporting period with the effect that liability become payable on demand on the reporting date, if the lender before the approval of financial statement for issue agrees to waive the breach, it shall be considered as an adjusting event. It shall be considered as an adjusting event. Means can I say it will not be classified as current liability? It will not be classified as current liability. Means what they want to say? Means if I conclude as per Ind AS 1 and Ind AS 10, whenever there is a long-term borrowing, correct? So long-term borrowing means non-current liability. non-current liability. Correct. Now, if there is any material breach, yeah, breach of material provision provision for the terms and conditions. Material provision means what? I can say material means what? So, for example, non-payment of interest on due date, non-payment of principal amount on due date, or submission of profitability report if required quarterly basis. Correct now. So this become what? Breach of material provision. I hope you understood. On or before, on or before a reporting date, on or before reporting date. Correct. Understood. So can I say with this effect, what is the effect of this breach? Can I say the loan will become a repayable on demand? So as per contract, the loan will become a repayable on demand. The loan will become a repayable on demand. Understood? So when it become repayable on demand, so as per the definition of current liability, it will be considered as current liability. So non-current liability will become current liability. Current liability. Understood? So there can be two situations in this case. Correct? What they said? If lender means the financier agree agree not to demand not to demand not to demand payment not to demand payment. I hope you are understanding. So if the lender agree not to demand payment and lender agree after reporting date before approval of financial statement, so lender agree not to demand after reporting date but before approval of financial statement. Correct. Understood. Then what Ind AS 1 says, what Ind AS 1 says, ki it will not be classified as current liability. It will not be classified as current liability means it will be classified as non-current liability. Correct now. So what Ind AS 1 says, it will be classified as non-current, and what Ind AS 10 says, ki it will be considered as adjusting event. Adjusting event means what? Ki the due to breach it become current liability, but it will become an adjusting event and will classify current liability as non-current liability. Are you able to understand? So it is adjusting event, that is it is nothing but classified as what? Non-current. Understood? But this point will be applicable whenever lender agree not to demand payment, what, after reporting date but before approval of financial statement. Means in other case, correct, can I say this will be classified as current liability. It will be classified as current liability. Means if there is a breach of material provision on or before reporting date, with the effect that loan become repayable on demand, and lender does not agree for this point, does not agree means lender has not done any agreement for not demanding payment, then it will be considered as current liability only. This was given under Ind AS 1 and Ind AS 10 as a carve out. Means now what IAS 10 IAS 1 says, IAS 1 says it will be classified as current liability in this case also, in this case also. And under IAS 10 they have said it is what non-adjusting event. It is non-adjusting event. I hope you have understood this point. This is what carve out. This point have you understood? Have you understood this point? Yes sir, we have understood. Non-adjusting event. Only this much you need to understand. Means what they say, let us read. IS1 require that IS1 require that in case of a loan liability, if any condition of loan agreement which was classified as non-current, if any condition, they have said any condition means what? Whether it is material or immaterial, whether it is material or immaterial means IS1 consider any type of breach, whether it is material breach or immaterial breach, correct? So any condition of the loan agreement which was classified as non-current is breach on the reporting date. Such loan liability should be classified as current even if breach is rectified after balance sheet date. Even if breach is rectified after balance sheet date. I hope you have understood. I hope you have understood this point. Have you understood this point? Correct. But as per Ind AS 1, if it is rectified after balance sheet date, but before approval of financial statement, then it will not be a current liability. It will be a what? Non-current liability. What they said, entity does not classify it as current. Yes, sir. Understood. What is given under Ind AS 10? Rectification of any breach after the end of reporting period is a non-adjusting event. Is a non-adjusting event. Correct. Why this was given as a carve out? Just try to know. Internationally, banks are very strict. Banks are very strict. Means any condition is not satisfied. Any condition is not satisfied. Bank is very strict. Means normally internationally it is not rectified. Normally, so they have taken that into circumstances that on reporting date will give the true and fair picture of what? The financial statement, and this will not be considered as what? Adjusting event. This will not be considered as adjusting event. I hope you are understanding. But can I say, if it is rectified after balance sheet date before approval of financial statement, then on reporting date, what is the true picture of financial statement? The true picture of financial statement that it is not a current liability, it become non-current liability. So if it is rectified after balance sheet date but before financial statement, that known is fact. So the fact is known to us. I hope you are understanding. So what they said, carve out has been made as it is felt that breach is rectified after the balance sheet date and before the approval of financial statement, it would appropriate that users are informed about the true nature of liability being non-current liability and not current liability. Because of that reason, carve out was brought. Means I will say from my point of view, the correct picture has been given under Ind AS 1 and Ind AS 10. From my point of view, IAS 1 and IAS 10 is not giving the correct picture of financial statement on reporting date. But I hope this was taken into consideration in international accounting standard. Why? Because banks are more strict internationally. Indian banking system, and they have only considered material breach in India. So if there is a if there is a suppose non-submission of any document, so bank will never demand the amount of loan. So for I will say immaterial breach, they have not considered this point only. So there is a breach of what? Material provision. Correct? Yes, sir. I hope you have understood. So can I say point number one and point number two is over? Point number one and point number two is over? Yes, sir. Yes, sir. Coming to point number three. In AS 28, investment in associate and joint venture. You know about equity method? Equity method. This is not this difference will not give any difference from examination point of view. Correct now. Only one phrase has been added under Ind AS 28. First, let us see what IAS 28 says. IAS 28 require for the purpose of applying equity method of accounting in the preparation of investor financial statement, uniform accounting policies should be used. In other words, if the associate accounting policies are different from those of investor, the investor should change the financial statement of associate by using same accounting policies. Means what they want to say. Point number three we are doing correct. Means this is investor, correct, and this is associate. Now you know who are associate, correct? So can I say investor will prepare CFS and this CFS investment in associate or joint venture. Associate or joint venture will be accounted by using which method? Equity method. Now to apply equity method, both investor and associate financial statements should be based on same accounting policies. Means if associate or joint venture using different accounting policies as compared to investors financial statement, therefore associate or joint venture financial statement first need to be prepared based on uniform accounting policies as used by investor. Correct now. For example, investor using for inventory valuation, they are using FIFO, and associate is using weighted average price method. Correct? Understood? So we need to change these accounting policies for applying equity method. Correct? And for this we need to follow what? FIFO. And then only we can apply equity method. Same thing is given under Ind AS 28 also. Means IAS 28, Ind AS 28 says same point, but Ind AS 28 has added one phrase. What they have said? Just check. In Ind AS 28, the phrase unless impracticable to do so means same thing is given. What Ind AS 28 says, Ind AS 28 also required for the purpose of applying of equity method of accounting in the preparation of investor financial statement. Uniform accounting policies should be used unless impracticable to do so. They have added one phrase unless impracticable to do so. Means some relaxation has been given under Ind AS 28. Means by adding this phrase, some relaxation has been given. A relaxation has been given. Means if associate are not able to prepare financial statement based on accounting policies of investor, then some relaxation has been given कि we can do consolidation based on equity method without changing the accounting policies unless impracticable do so. So how impracticable situation arise? It might happen there are many associate, there may be many associates which are not applying Ind AS. For example, many nationalized bank have RRB. RRB means what? Regional Rural Bank. And for regional rural bank, Ind AS is not applicable. Are you getting? So this this phrase has been added for this situation. What they have said, certain associate, example, RRBs, being an associate of nationalized bank, are not in a position to use the index as this may be too advanced for the RRBs. Accordingly, the above stated word have been included to exempt such associate. To exempt such associate means then such associate are exempted for preparing financial statement based on accounting policies of investor. I hope you have understood this point. Correct? Have you understood this point? Means equity method need to be applied in that situation also, but without uh, preparing financial statement of associate based on accounting policies of investor. I hope you have understood. Yes, sir. Have you understood this point? But this carve out is not important from examination point of view. Correct now, because there cannot be any question, practical based question on this. They may give a case study कि there is some associate who are not able to apply the uniform accounting policies because they are not applying Ind AS. So we can use this, yes, as per Ind AS 28. There is some exemption given, but as per IAS 28, no such exemption is given. No such exemption is given. Yes, sir. Understood. Then point number 4, Ind AS 32 financial instrument presentation. This is very important carve out. This is very important carve out. First, let me read what we have done under Ind AS 32. When I will read, you will understand this is special point we have done under Ind AS 32. What we have done in Ind AS 32 means financial instrument chapter. An exception has been included to the definition of financial liability in para 11b2. Correct? In para 11b2, that is not required, whereby conversion option in a convertible bond denominated in foreign currency means foreign currency convertible bond. So an option is there, conversion option, to acquire fixed number of entities own equity instrument is classified as equity instrument if the exercise price is fixed in any currency. Means if you remember in days 32 we have done one point. Whenever whenever due to conversion variable number of equity shares are issued, then it will be considered as financial liability. And if the settlement will be done in fixed number of equity shares, then it will be classified as equity instrument. However, if you remember fixed to fixed test means if consideration is also fixed, if the consideration is also fixed and number of equity shares is also fixed, then that instrument will be classified as equity instrument. It will not be classified as what financial liability. Correct? And if either or both means either consideration is variable or number of equity shares is variable or both are variable, then it will be classified as what? Financial liability. It will be classified as financial liability. Correct? Means what Ind AS 32 says. We are doing point number 4. Correct? Means suppose there is a foreign currency convertible bond of dollar 10 lakh. Dollar 10 lakh which will be converted into equity shares at an exercise price of rupees 20, at an exercise price of rupees 20. Correct? Understood? The foreign currency convertible bond which will be converted into equity shares at an exercise price of rupees 20. You can see this is rupees 20 and this is what? In dollar. Understood? Correct? Now suppose if I say कि there is a convertible debenture of rupees 10 lakh which will be converted into equity shares at an exercise price of rupees 20. So how much equity shares? This is become how many equity shares? So can I say 10 lakh divided by 20 is equal to 50,000. Then can this 50,000 is fixed number of equity shares? Fixed number of equity shares. It become a fixed number of equity shares. Why? Fixed number of equity shares. Why? Because this consideration is also fixed and exercise price is also fixed. So number of equity shares is also fixed. Therefore, can I say fixed to fixed test is satisfied, and therefore the entire instrument will be classified as equity instrument. And when we say equity instrument, then subsequent recognition measurement of equity instrument is not permitted. When I am saying it is a financial liability, then can is a financial liability need to be subsequently recognized and measured at its fair value or at amortized cost. I hope you are understanding. Yes, sir. Correct. So when it is convertible debenture, where the consideration and exercise price are both in same currency, then there is no doubt. But you can see in this case, in this one doubt will come. Ki if you want to find out number of equity shares, so again number of equity shares will be equal to 10 lakh dollar multiplied by exchange rate on the date of conversion, exchange rate on the date of conversion, on the date of conversion divided by 20. Correct. And can I say due to changes in exchange rate, right now we don't know how much is the number of equity shares. We don't know what is the exact number of equity shares to be issued. But what India's 32 says, we need to understand the substance of this contract. And substance was that there was an intention to issue fixed number of equity shares. Now that number of equities is not known to us right now because of changes in exchange rate, because of fluctuation in exchange rate. Therefore, this will be considered as fixed number of equity shares, and it will be classified as equity instrument. It will be classified as equity instrument. Correct. It is given under India's 2, sorry, India's 32, which is, I will say once again, correct. Means India's 32 is more, it is more fair. I'm saying it is India's 32 is given more fair picture of what accounting treatment. I hope you have understood this point. But what is given under IAS 32? Let's see. As per the accounting treatment prescribed under IAS 32, as per the accounting treatment prescribed under IAS 32, equity conversion option in case of foreign currency denominated convertible bond is considered as derivative liability. Is considered as derivative liability, means it is a derivative liability which is embedded in the bond, means it will be considered as embedded derivative. And whenever there is an embedded derivative, can you see it need to be split? It need to be split from the host contract. If you remember the concept of embedded derivative, and that will be considered as derivative liability, and derivative liability need to be measured at FBTPL, and any gain or loss will be transferred to what? Any gain or loss will be transferred to PL. I hope you understood. Correct. So it will be considered as derivative liability which is embedded in the bond. Gain or loss arising on account of change in the fair value of derivative need to be recognized in statement of PL as per IAS 32. And if it is derivative liability, the derivative liability will measure FBTPL. So any change in the fair value, any change in the fair value of derivative liability will be recognized in PL. But as India is 32, can you see it is equity instrument? So if it is equity instrument, the question of subsequent recognition will not arise. Means if it is equity instrument, then nothing will be transferred to PL. Nothing will be transferred to PL once it is issued. Once it is issued. I hope you understood. So under IAS 32, equity conversion, equity conversion option which is given will be considered as embedded derivative, and that will be classified as derivative liability, which need to be split on initial recognition, and derivative liability will be measured at FBTPL, and any subsequent gain or loss due to subsequent recognition will be transferred to what? PL, will be transferred to PL. Understood? But Ind AS 32 says no, it will be equity instrument. Why Ind AS 32 has said no? What reason they have given? What they have said? This treatment as per IAS 32 is not appropriate in the instruments such as foreign currency convertible ones, since the number of shares convertible on exercise of option remain fixed. Number of shares convertible on exercise of options remain same, and the amount at which options to be exercised in terms of foreign currency is also fixed. Means number is also fixed and the consideration is also fixed. Therefore, it will be equity instrument. Correct. Merely the difference in the currency should not affect the nature of derivative. Merely the difference in currency means any difference in currency due to fluctuation in exchange rate should not be should not affect the nature of derivative. That is the option. Further, the fair value of option. Now, if it is derivative option, then this fair value of option is totally based on the fair value of shares. Means the fair value of shares will increase, the fair value of options means fair value of equity conversion options will also increase. Correct. So what they said, further the fair value of option is based on fair value of the share price of the company. If there is a decrease in share price, if there is a decrease in share price, the fair value of derivative liability would also decrease, which would result in recognition of gain in the statement of PL. Means if the market price of shares is decreasing, the value of derivative liability will also decrease, and which will be transferred as a gain to SOPL. Correct? Which will be transferred as a gain to PL. Correct? Are you able to understand? However, can I say if the price of shares if the price of shares decrease, so no one will exercise only. If they will not exercise it, the question of gain or loss will not arise. Are you able to understand what I am saying? So what they are saying, just try to understand what they want to say. If you are considering it as an option, so these options will be exercised only when the market price of shares is more than exercise price. Only when the market price of shares is more than exercise price. If the market price of shares is less than exercise price, they will not exercise only. Correct now. And if they are not exercising it, the question of recognition of gain or loss will should not arise in SOPL. Means what they want to say, ki in this case, the fair value of option is based on the fair value of share price. If the price of shares is decreasing, then price of derivative liability means value of derivative liability will also decrease. Correct. And if the value of derivative liability will decrease, it will result in gain, and you will transfer that gain to SOPL, which is not fair, because in that case you will not exercise the options. If you are not exercising the option, the question of recognition of gains would not arise. I hope you understood. Correct? Yes, sir. This would bring unintended volatility in SOPL due to volatility in share price. This will not give a true and fair view of liability in this situation. When the share price fall, the options will not be exercised. However, it has been considered that if such option is classified as equity, fair value changes would not be required to be recognized. Accordingly, the exception has been made in the definition of financial liability in Ind AS 32. So I hope you have understood what is the reason of this carve out. I will say Ind AS is more relevant, it is more fair than IAS 32. Have you understood this point? Have you understood? You are not responding. Please respond. Have you understood this point? Point number 4. Yes, sir. Point number 4 also we have understood. But if you are giving answer based on IAS 32 in GFRS paper, you should consider that equity conversion as derivative liability. You need to clear in GFRS paper. If question is silent, means if they have not mentioned that whether you need to answer as by Ind AS or IFRS, you need to give answer based on IFRS or IAS. Correct? Yes, sir. Then point number 5. Ind AS 101 first time adoption of accounting standard. First carve out is in the definition of previous gap under Ind AS 101. Ind AS 101 says previous gap means which is which is based on Indian context. Means previous gap means financial statement prepared based on company's accounting standard rules 2006. Correct? So what they have said, Ind AS 101 defined previous gap as the basis of accounting that first time adopter used for his reporting requirement in India. Correct. The basis of accounting that first time adopter used for his reporting requirement in India immediately before adopting India's. Correct. The change made it mandatory for Indian entities to consider the financial statement prepared in accordance with notified accounting standard as was applicable to them as previous gap when transition to India. So this accounting standard means accounting standard notified under companies accounting standard rules 2006. Means it might happen, just try to understand what why they have given this carve out. Means as per IFRS 1, what they have said, IFRS 1 defined previous gap as the basis of accounting that first time adopter use immediately before adopting IFRS. Means they have not said the word India. In India's 101, they have added one phrase. What is the phrase? Ki, which was used for his reporting requirement in India, which was used for reporting requirement in India. That word has been used. Means what this word means, what this phrase, why this phrase has been added. For example, there is one company, A Limited. A Limited. A Limited is listed in Bombay Stock Exchange as well as, let us assume, London Stock Exchange also. Correct. Now, before adoption of India's, for example, suppose India's was applicable on 1/4/2016, and for the year 15/16, they have prepared two financial statements. One was based on IFRS and one was based on AS notified under company's accounting standard 2006. Correct. Now India is applicable from 1/4/2016. Correct. India is applicable from 1/4/2016, means date of transition will be 1/4/2015. This you know, date of transition uh, will be the beginning of previous year. Yes sir, correct. So date of transition is 1/4/2015. Correct. Now, in this one doubt will come, previous gap will be which gap? Because they are preparing two financial statements. One is based on IFRS, one is based on AS. So they have given one clarification कि the first time adopter, the previous gap means the previous gap means कि the financial statement which is prepared in India as per Indian context. Correct now? As per Indian context means what they want to say कि define previous gap as the basis of accounting that FTA used for its reporting requirement in India. For reporting requirement in India. So for reporting requirement, this is reporting requirement in India. Therefore, previous gap will be this. This will be previous gap. So this is one clarification I will say. Once again, this will not make much difference between Ind AS and IFRS. Correct? Understood. I hope you have understood. Correct? This was point number 5 ka point number 1. This was 5 ka point number 1. Correct? Yes, sir. Understood? Yes, sir. Then point number 2. Point number 2. I hope you remember that there are some mandatory exemption given under Ind AS 101 and there are some voluntary exemption. One of the voluntary exemption was given for PP. And what was the voluntary exemption? Ind AS 101 provide an additional option to use carrying value of all item PP, of all item of PP on the date of transition in accordance with previous gas as acceptable starting point for under Ind AS. Means what is the voluntary exemption? Key for recognizing PP on the date of transition, either they can apply Ind AS 16 retrospectively. I'm writing this side. Means what India's 101 says. This is point number 2. What India's 101 says? Correct. The carrying amount of PP on the date of transition can be determined point number A by applying Ind AS 16 retrospectively or 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 at deemed cost. You remember this word deemed cost? Now deemed cost, it may be they have given two options. It may be point number 1, fair value of PP on the date of transition, or carrying amount of PP, carrying amount of PP as per previous gap, as per previous gap on the date of transition. On the date of transition. I hope you remember. Correct? Means under Ind AS 101, they have given one exemption that you are not supposed to apply retrospective application. You can apply the accounting treatment prospectively by taking deemed cost. Under deemed cost, they have given two options. Either you can take fair value of PP on the date of transition, or you can take what carrying amount of PP as per the previous gap. But under IFRS 1, you can see first time adoption of international accounting standard provide that on the date of transition either item of PP shall be determined by applying IAS 16 retrospectively, IAS 16 retrospectively, or same should be recorded fair value on the date of transition. Means they have not given which option carrying amount of PP as per previous gap, that is not given. This is one carve out. This is one carve out. Can I say this has been the option has been given to make adoption more easy? Because if they have not given this option, fair value is very subjective, and to determine fair value, can I say we need to go to competent valuer, and it will become an expensive method. So there may be many companies which are not big company, so they will be very much reluctant to apply what India's in India. So these are given some as a relaxation to the entity those so that they can easily adopt India's. I hope you have understood. Yes, sir. What they said. In case of old companies, retrospective application of Ind AS 16 of fair value at the time of transition to determine deemed cost may not be possible for old assets. Accordingly, Ind AS 101 provide relief to an entity to use carrying value of all item of PP on the date of transition in accordance with previous gap as an acceptable starting point under Ind AS. I hope you have understood. Correct? Means you need to be very much clear. If under GFR they are asking, so you cannot start by using carrying amount of PP as per previous gap. Means either you need to apply IAS 16 on a retrospective basis, or you need to take fair value on the date of transition. Yes, sir, we have understood. Then long-term foreign currency monetary item as per IFRS. Long-term long-term foreign currency monetary item. If you remember, under AS 11, there was one para 46 and 46A. And due to that para, such some option were given to the entity. And that option was that instead of transferring any exchange difference on long-term foreign currency monetary item to PL, they can either capitalize it to the cost of depreciable asset, or they can accumulate that exchange difference to a special account known as foreign currency monetary item translation difference account. You remember? You remember? So one option was given to the entity under previous gap. So under Ind AS 101, one voluntary exemption has been given. That entity who has opted the option given under para 46 oblique 46A under AS 11, if they have opted that option, so they can continue the same accounting treatment for foreign currency monetary item, for long term foreign currency monetary item for which such option was availed. This exemption was given under Ind AS 101, but such provision is not given in IFRS 1. What they said? Paragraph D13AA of Appendix D to Ind AS 101. This is not required to be learned. Paragraph D13A of Appendix D to Ind AS 101 provide that first time adopter may continue the accounting policy adopted for accounting for exchange difference arising from translation of long term foreign currency monetary item recognized as per previous gap. Means they can continue the same accounting policies, correct, which they have adopted for accounting for the exchange difference arising from long term foreign currency monetary item as per previous gap. What was that? Para 46A or 46, means initially it was 46, then it was changed to 46A, correct. Now para 46A of AS 11 provide an option to recognize long-term foreign currency monetary item in SOPL as a part of cost of property, plant and equipment, or to defer its recognition in statement of PL over the period of loan in case the loan is not related to the acquisition of fixed asset. Means if I say what was para 46A? Para 46A, they have given an option to the entity. Option was for long-term foreign currency monetary item. Means this option was not for short term long term foreign currency monetary item. Means suppose you have taken a loan for less than 12 months, correct, now then it becomes short term foreign currency monetary item. So for that exchange difference will be always transferred to PL. The option was given only for what? Long term foreign currency monetary item. And as per that option, they said either exchange difference can be transferred to PL or exchange difference if if foreign currency monetary item is related to acquisition of depreciable asset, then exchange difference will be adjusted to the cost price of asset, correct, and depreciation will be charged on prospective basis and depreciate such asset on prospective basis. On prospective basis over the remaining useful life of that asset, over the remaining useful life of asset, correct. Then if foreign currency monetary item is not related to acquisition of depreciable asset, then exchange difference will be accumulated in FCMI TD account. FCMI TD account means foreign currency monetary item translation difference account. Correct? Which will be amortized in PL on SLM basis over the life of foreign currency monetary item. So this was option given. Correct? Understood? Correct? Now, if they have availed this option, means if they have availed this treatment, so such accounting policy can be followed on the date of transition. Are you getting? Means entity who has availed the option of not transferring the exchange difference on long-term foreign currency monetary item to PL immediately, then such entity may follow the same accounting policies even though they have adopted India's, but they can follow this accounting policy only for those foreign currency monetary items which were existing on the date of transition and for which such option was exercised. If suppose there was some foreign currency monetary item for which such options were not exercised, for that they cannot avail they cannot avail such exemption. I hope you have understood this point. This was given under what? Ind AS 101. And because of this, one one changes was made under Ind AS 21 also. What Ind AS 21 says, consequently Ind AS 21 also provide that it is not applied, means Ind AS 21 is not applicable to long-term foreign currency monetary item for which entity has opted for exemption given under para D13AA of Appendix D to Ind AS 101. Correct. Such an entity may continue to apply the accounting policy. Such entity may continue to apply accounting policy so opted as per previous gap for such long-term foreign currency monetary item. For such long-term foreign currency monetary item means for which options were exercised. For such means what? For those foreign currency monetary item for which for those foreign currency monetary item for which what? For which options was availed. Means for any new foreign currency monetary item they need to apply Ind AS 21 only. I hope you have understood. This provision is not given in IFRS 1 because under IFRS 1 as per previous gap there was no para 46. I hope you have understood. Yes sir. Correct? Yes sir. Then point number 6, Ind AS 103 business combination means we have done with first time adoption Ind AS 101. Now we are coming to Ind AS 103. Under Ind AS 103, whenever there is a gain on bargain purchase, so that gain on bargain purchase will be transferred to OCI and accumulated in a separate company equity, that is capital reserve. You remember this point? So under Ind AS 103 requires that bargain purchase gain to be recognized in OCI and accumulated in equity as capital reserve. A similar carve out is made in Ind AS 28 also. Ind AS 28 also. Under Ind AS 28 also, when we apply equity method and if there is some gain, that gain will be transferred to OCI and accumulated in what? Capital reserve. If you remember, correct now. Investment in associate and joint venture. Means if I say in detail about Ind AS 103. Ind AS 103 says whenever there is gain on bargain purchase, correct? Gain on bargain purchase you understood, correct na? Yes sir. So I'm not informing you about how to calculate gain on bargain purchase, correct na? Yes sir. So whenever there is a gain on bargain purchase, there can be two situations. If there is evidence for gain, if there is evidence of gain, correct? So what they are saying, bargain gain will arise only when the acquiree is under compulsion of sale. Then only we can do bargain. Means the acquiree is under financial stress. So if there is an evidence for such gain, then this gain will be recognized in OCI and accumulated in capital reserve. Correct? Understood? So if there is evidence of gain, correct? Then on if there is no evidence of gain, correct? So what India's 103 says, this is rare circumstances. Rare circumstances means when there is no, means when acquiry is not under compulsion of sale, so of course they will they will charge consideration which is equal to the fair value of net asset or more than fair value of net asset. Of course they will not charge less than fair value of net asset. I hope you are understanding. So it is a rare circumstances. So what they said in this case, there might be some mistake in valuation. So what they are saying, then do remeasurement of INA, NCI and purchase consideration is required. Well, do remeasurement of INA, remeasurement of value of INA, value of NCI and purchase consideration is required. Like, if still gain exists, if still gain exists, so this gain will be transferred to capital reserve directly. Will be transferred to capital reserve directly. Means it will not be transferred through OCI to capital reserve. I hope you have understood. So this is given under Ind AS 103. But as per IFRS 3, in any situation, whether this is the situation or this is the situation, what they said, gain will be transferred to PL. Gain will be transferred to PL. Means can I say they are becoming more regular? Means they are transferring a gain which is unrealized right now to profit and loss. So what Ind AS 1 means, what Ind AS 103 says, this is not correct. You are transferring a gain which is right now unrealized to profit and loss account, which will be available for dividend to the shareholders. But this is not correct. Therefore, gains to be transferred to OCI and accumulated to capital reserve. So what they said, IFRS 3 require bargain purchase gain arising of business combination to be recognized in PL as income. Understood. From my point of view, also it should not be transferred to PLS income. What reason they have given? What reason has been given under India's? Correct. At present, since bargain purchase gain occur at a time of acquiring a business, these are considered as capital reserve. Recognition of such gain in PL would result into recognition of unrealized gain, which may get distributed in the form of dividend. Moreover, such treatment may lead to structuring through acquisition. Means, can I say this can be used as a tool for restructuring the financial statement of any company. Means they will do planning and they will calculate gain, and the financial statement of the company may be what if may be restructured due to this. Are you able to understand what I am saying? So this may lead to structuring through acquisition, which may not be in the interest of the stakeholder of the company. Understood? I hope you have understood. Now, whether they will ask reason in exam, that I don't know. But in exam, if question is silent, always you need to give the treatment as per IFRS in GFRS paper. Yes, sir. We have understood. Now, coming to the last point of carve out. Ind AS 115 revenue from contract with customer. This is very simple. What they said, in case of penalty, means if there is a penalty clause in any contract. So IFRS 15 says that penalty will be considered as variable consideration in all cases. Means what IFRS 15 says, IFRS 15 provide that all types of penalty which may be levied in the performance of a contract should be considered in the nature of variable consideration for recognizing revenue. Means any type of penalty should be considered as variable consideration, and for variable consideration we do some estimation to calculate transaction price, if you remember. Yes, sir. But what Ind AS 115 says has been amended to provide that penalties shall be accounted for as per the substance of the contract, as per the substance or the nature of the contract. When the penalty is inherent in determination of transaction price, when the penalty is inherent in determination of transaction price, it shall form part of variable consideration. Otherwise, same should not be considered for determining the consideration, and transaction price shall be considered as fixed. Means in that case, transaction price will not be considered as variable, it will be considered as fixed. Means we need to find out those variable which are inherent in the determination of transaction price. That penalties will be only considered as variable consideration. Means those penalties which are not inherent for the determination of transaction price, that is not considered for determining the transaction price. I hope you have understood. Means that will be excluded for determination of transaction price. Yes, sir. This is what Ind AS 115. Very simple. All the carve out have been done. So if you see, if you have done the carve out, this much carve out we have done, and we cover when we cover this much carve out, more or less the all the significant difference has been done. Now there is one carving is very easy. Carving is only one. Ind AS 103 business combination. Under Ind AS 103 you have done appendix C to Ind AS 103 business combination, give guidance in this regard. Means this is nothing but business combination under common control. Under common control, you remember, under common control. Under common control means they have said use pooling of interest method. Pooling of interest method. Pooling of interest method means what? All assets and liability of transfer company will be incorporated in the financial statement of transfer company at book value. Correct? Reserve need to be maintained, and any difference between purchase consideration share capital of transfer company will be adjusted in capital reserve. If you remember, this is business combination under common control. Correct. However, IFRS 3 exclude from scope business combination of entities under common control. So they have not given any guidance for the business combination among entities under common control. So IFRS 3 is silent, I will say. So this is additional guidance over and above the guidance given under IFRS. Therefore, it is carving, carving, carving. Understood? So there is only one carving. Yes, sir. We have understood. Correct. So this was carve-in and carve-out. Understood. Now we'll come to the other difference. Other major changes in Indian accounting standard in relation to IFRS not resulting in carve-out. Means this is due to either terminology change or removal of option under Ind AS. Removal of option under Ind AS. So either due to terminology change or removal of options. Correct now. Understood? Yes, sir. Have you understood? What? First, statement of PL means Ind AS 1 presentation of financial statement. Under IAS 1, Under IS1, for presentation of SOPL, they have given option. Means either SOPL can be prepared in two statement or one single statement. This option has been given. So with regard to the presentation of SOPL, IS1 provide an option either to follow single statement approach or to follow two statement approach. Two statement means what? It will be statement of PL and statement of OCI, other comprehensive income, or they can prepare statement of comprehensive income with two part, as we do in India. Correct. But India's one allows only one single statement approach with profit or loss and OCI presented in two sections. Understood? This only we do. So under IAS one option has been given either single statement or two statement. Yes, sir. Terminology change. India's one is changed to remove alternative by giving one terminology to be used by all entity. Means what they said ki financial statement, the component of financial statement will be given only one terminology. Means balance sheet will be only known as balance sheet. Statement of PL will be only known as statement of PL. I hope you're understanding. But IS1 gives the option to the individual entity to follow different terminology for the title of financial statement. Means this is IS1 says that you can either use statement of financial position or you can use any other terminology for that statement of financial position. Correct? Understood? Yes, sir. But this has been removed from Indian accounting standard. ये बैटरी ये लोग लो क्वालिटी का दिया है. Is it audible now? Everyone, is it audible? Yes, sir. Okay. So have you understood till now whatever we have done? Have you understood till now whatever we have done? चलो. The first point is, have you understood statement of PL? So what I have said कि under IS1 provide an option to prepare SOPL either as a single statement or as a two statement. Correct? But under Ind AS 1, SOPL need to prepare only as a single statement. Correct? Second point, terminology. As per IS1, what they say, as per IS1, IS1 once again has given an option to the individual entity to follow different terminology for the titles of financial statement. Means as per IS1, entity can use different terminology for the items of financial statement. Means one entity may use statement of financial position, other entity may also use balance sheet. Correct? But under Ind AS 1, because under Ind AS 1 financial statement terminology will be decided as per the legal requirement, means as per company law. Therefore, such option has not been provided. So under Ind AS 1 is changed to remove the alternative by giving one terminology to be used by all entities. Understood? Correct. Point number 2 you understood. Come to point number 3. Now under IAS 1 periodicity periodicity. For example, they have said 52 weeks for preparation of financial statement. So they have given a periodicity limit कि after every 52 weeks financial statement should be prepared. Financial statement should be prepared. Correct? Understood? But this is not given under Ind AS 1 because preparation of financial statement once again will be decided as per legal requirement. As per legal requirements, as per Companies Act, every company should prepare financial statement at the end of each financial year, that is 31st March. But this is based on legal requirement, therefore such option has not been given. Such provision has not been given. Understood? Yes, sir. Then classification of expense, this is very important. Under IS1, what they said, कि IS1 require analysis of expenses recognized in PL using a classification based on either their nature or their function within the equity. Means the expense can be either classified based on their nature or based on their function. If I say based on their nature, it means it will be employee benefit expense, uh, employee benefit expense, depreciation expense, finance cost expense, other expense, etc. As per function means production expense, admin expense, office expense, selling expense, and so on. But this option has been removed under Ind AS 1. Ind AS 1 says expense need to be classified only on the basis of nature, not on the basis of their function. So Ind AS 1 require nature-wise classification of expense. Nature-wise classification of expense. Correct? Understood? This much. Then next point. IS1 require that items of dissimilar nature or function shall be presented separately unless these are immaterial. Unless these are immaterial. Correct? Understood what I am saying? So what IS1 says, item of dissimilar nature or function shall be presented separately unless these are immaterial. Means in simple word, any items of dissimilar nature, if these are material item, need to be disclosed separately. Correct? If they are immaterial, then we can club together. I hope you understood. But under India's one phrase has been added to this para. What is that phrase? What they said? As per India's such paragraph have been modified to include except when required by law, except when required by law. This has been added. Means what India's says कि items of dissimilar nature shall be presented separately unless these are immaterial except when required by law. Except when required by law means even though dissimilar items are immaterial, need to be disclosed separately if required by law. If required by law. For example, as per Schedule 3 of Companies Act, as per Schedule 3 of Companies Act, interest expense, director's remuneration, auditor fees need to be disclosed separately. Means it need to be disclosed separately even though amount is immaterial as per the requirement of Schedule 3. So therefore this phrase has been added except when required by law. Have you understood? So as per India's can I say in this way that the items of dissimilar nature of functions shall be presented separately unless these are immaterial except when required by law. Understood? Correct? Understood? Yes, sir. Then gain on bargain purchase. Now, one thing we have understood that gain on bargain purchase is transferred to capital reserve under Ind AS and is transferred to PL as per IFRS 3. Correct? So because it is transferred to capital reserve under Ind AS, therefore Ind AS 1 says a reconciliation is required for capital reserve for this gain on bargain purchase. Means what they said, as per Ind AS 1 dealing with disclosure regarding reconciliation between the carrying amount at the beginning and at the end of the period for each component of equity has been amended to include disclosure regarding recognition of bargain purchase gain arising from business combination in line with the treatment prescribed in this regard under Ind AS 103. But again, this paragraph was not required under IAS 1 because there was no gain on bargain purchase transfer to capital reserve as per IFRS 3. Understood? Yes, sir. So no such requirement. No such requirement. Understood? Yes, sir. So Ind AS 1 understood. So these are some more changes, but these are not carve out and carve in. Means can I say this will not affect the accounting treatment. This will not affect the accounting treatment. Carve out and carve in will affect the accounting treatment as compared to IFRS. As compared to IFRS. Understood? Yes, sir. Yes, sir. Then Ind AS 2 inventory. Ind AS 2 inventory. Ind AS 2 inventory. Now, what IAS 1 says कि we can recognize expense either on the basis of nature or on the basis of function. Because of that reason, what Ind AS 2 says, Ind AS dealing with the recognition of inventory as an expense based on function wise classification. So they have given one para dealing with the recognition of inventory as an expense based on function wise classification. But can this para is not required under Ind AS 2? Why? Because function wise classification is not required. So this para has been deleted under Ind AS 2. Understood? Because function wise classification is not required. Understood? Yes, sir. Then Ind AS statement of cash flow, IAS 7 statement of cash flow. Now what IAS 7 says, in case of any companies which are other than financial companies, means any entities which are not banking companies, NBFC, IS 7 gives an option to classify interest paid and interest and dividend received as an item of operating cash flow. Under IS 7, interest paid, interest and dividend received can be classified either as operating item as well as what? As well as investing or financing item. Means under Ind AS 7, Interest paid will be always financing activity, and interest received and dividend received will be always investing activity, if you remember. So does not provide such an option and require this item to be classified as item of financing activities and investing activity respectively. Means interest paid will be financing activities, and interest and dividend received will be investing activities. But under IAS 7, it can be either investing or financing or operating activities. An option has been given to the entities. Yes, sir. Such option has been removed. Yes, sir. Then IS 7 gives an option to classify dividend paid as an item of operating activity. Oh my god. Dividend paid can be also classified as an operating activities. But under India 7, it will be always financing activities, correct? So it will be always classified as a part of financing activity. Understood? Correct. I hope you have understood this point. Yes, sir. This point. Then coming to Ind AS 8, accounting policy changes in accounting estimate and error, IAS 8. This difference is not relevant. This difference will arise because of IFRS. What IFRS says? IAS 8 provided IFRS are accompanied by guidance to assist entities in applying their requirement. Correct? So IFRS are accompanied by a guidance to assist entity in applying their requirement. Guidance that is integral part of IFRS is mandatory, and guidance that is not an integral part of IFRS does not contain requirement for the financial statement. Means this guidance, as per IFRS, they have given two guidance which are integral part of financial statement, guidance which are not integral part of financial statement. So guidance which are integral part of financial statement are mandatory to be applied while forming accounting policy for a given treatment. Correct? But such explanation is not given under Ind AS. Check करेंगे. Under Ind AS, para 9 has been modified by not including the text given in the context of guidance forming non-integral part of Ind AS. As such, guidance has not been given under Ind AS. But under Ind AS, there is no such guidance given. Under Ind AS, no such guidance has been given. Understood? Have you understood this point? Yes, sir. Correct? Yes, sir. So this is not a major difference, I will say. From examination point of view, this difference is not relevant. Now, Ind AS 12 income tax, IAS 12 income tax. IAS 12 require presentation of tax expense in a separate income statement where separate income statement is prepared. Can you say this difference arises because of SOPL, because SOPL can be prepared in two statement. So whenever you are preparing separate income statement, the tax expense should be presented in separate income statement. But this is not applicable for India. Correct now. Ind AS 12 does not require such presentation since in Ind AS 1 option regarding two statement approach has been removed. Understood? Correct? Have you understood? Yes, sir. This point have you understood? Correct. Then this is important. What they said. IAS 12 provide that acquired deferred tax benefit recognized within the measurement period that result from new information about the facts and circumstances existed at the acquisition date shall be applied to reduce the carrying amount of goodwill related to that acquisition. I hope you have not understood this point. Can you say as per Ind AS, let us come to first Ind AS 12. As per Ind AS 12, deferred tax asset or deferred tax liability need to be created on initial recognition of assets and liability in case of business combination, and the DT and DTL will be adjusted with goodwill or gain on bargain purchase if any. Correct now? Means under as per Ind AS 12, any deferred tax which arises due to assets and liability initial recognition of assets and liability in business combination, the deferred tax may be adjusted with goodwill or gain on bargain purchase if any. Gain on bargain purchase means it can be transferred to capital reserve. Yes, sir. So what they said, the treatment of gain prescribed in Ind AS 103 in comparison to IFRS 3, India's 12 provide that if the carrying amount of such goodwill is zero, means if it cannot be adjusted with goodwill, any remaining deferred tax benefit shall be recognized in OCI and accumulated in equity as capital reserve or recognized directly in capital reserve. Correct now? Means if goodwill amount is zero, so that deferred tax cannot be adjusted with goodwill, then it can be transferred to OCI and accumulated in capital reserve, or it can be directly transferred to capital reserve because of that difference in Ind AS 103 and IFRS 3. But in this case, they said if the goodwill amount is zero, that deferred tax effect will be transferred to PL. Deferred tax effect will be transferred to PL. So if the carrying amount of goodwill is zero, any remaining deferred tax benefits shall be recognized in PL. Shall be recognized in PL. Understood? Correct. Means under Ind AS 103, everyone, 1 minute. Under Ind AS 103, we pass one journal entry INA, account debit suppose 100 crore, to cash suppose 80, and to NCI suppose 20. So you can see goodwill is zero. Understood? The goodwill is zero. Correct now. So suppose we recognize any DTA, suppose 20. So this DTA will give rise to gain on bargain purchase 20. But I under IFRS 3, as per IFRS 3, if such situation arise, are you getting what I'm saying? And suppose there is a DTA. This DTA you created as per Ind AS 12. So Ind AS 12 has suggested it will be adjusted in gain on bargain purchase, which can be accumulated in capital reserve or directly transferred to capital reserve if the goodwill amount is zero. I hope you have understood what I am saying. But in this case, it will be transferred to PL. In this case, it will be transferred to PL. Have you understood this point? Have you understood this point? Yes, sir. Correct. This is important from examination point of view. Correct. Yes, sir. Then I have already said that there is one option given under IAS 40 that investment property can be subsequently recognized either at cost model or revaluation model. But such option has not been given under Ind AS 40. Because of that, one para has been modified under Ind AS 12. What they said, since fair value model is not allowed in Ind AS 40, para 20 of Ind AS 12 has been modified by not giving reference of Ind AS 40, and consequently para 51C and 51D has been deleted. Correct. So because now under Ind AS 40, fair value model cannot be applied for investment property. So some para has been modified or deleted under Ind AS 12. This is not relevant from examination point of view. Similarly, under Ind AS 16 also, due to option given under IS 40 and removal of option under Ind AS 40, some para has been what amended or deleted. So this is not important from examination point of view. Correct? Yes, sir. Correct. Then coming to Ind AS 19 employee benefit. Now, if you remember Ind AS 19, the discount rate will be based on yield rate of government bond. Yield rate of government bond. If you remember, so under Ind AS 19, the rate to be used for discounting shall be determined by reference to market yield on government bonds. But as per IS 19, that discounting rate will be based on based on yield rate of high quality corporate bond. Are you getting? So it is based on high quality corporate bond. So one option has been given under Ind AS 19. The government bond can be used only when there is no deep market of high quality corporate bond. Means if there is a deep market, means market of high quality corporate bond exists, then discount rate will based on yield rate of high quality corporate bond. If that market does not exist, then only we can take the market yield of government bond. But under Ind AS 19 always will take what? Market yield of government bond. Why? Because in India there is no perfect market for high quality corporate bond. Understood? Yes, sir. Correct? Yes, sir. Now, under India's 20, initially there was one difference, but this difference has been removed through amendment. Means initially, IS 20 require presentation of grant related to income in the statement of income statement. IS 20 require presentation. Sorry. This is I've already deleted that. Okay, this is correct. IS 20 require presentation of grant related to income in separate income statement. So this will be available because of statement in two statement option given in IS1. However, this requirement is not provided in Ind AS 20, consequential to the removal of option regarding two statement approach in Ind AS 1. Can I say this will always exist as a difference? Yes, sir. Then Ind AS 21, the effect of changes in foreign exchange rate. Correct? What they said? Ind AS 20 means this is not also important from examination point of view. Whenever there is a change in functional currency, whenever there is change in functional currency, IS 20 require disclosure of the fact and the reason for the change in functional currency. Disclosure of the fact and reason for the change in functional currency. But as per Ind AS 21, one additional disclosure is required, that is the date of change in functional currency. That was not required in IS 21, required under Ind AS 21. So date of change in functional currency is also required as an additional disclosure. Correct. Ind AS 23, if you remember para 6e, do you remember para 6e? You might not be knowing para 6e, but this is what for 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 borrowing for what exchange difference arising from foreign currency borrowing regarded as an adjustment to interest cost. You remember that? Ki borrowing cost will include exchange difference arising from foreign currency borrowing to the extent regarded as an adjustment to interest cost. We used to compare foreign currency borrowing with functional currency borrowing. You remember? Correct. Exchange difference will be covered under Ind AS 1, which will be lower of what? Actual exchange loss and the difference between interest in functional currency borrowing and interest in what? Foreign currency borrowing. Remember this point? Yes, sir. So for this, Ind AS 23 provided guidance in this regard. An explanation has been given under Ind AS 23, but such explanation has not been given under IAS 23. IAS 23 provide no guidance as how the adjustment prescribed in para 6C is to determine. But some explanation guidance has been given under Ind AS 23. That guidance already we have covered. Already we have covered under Ind AS 23. Correct? Understood? Yes, sir. Then Ind AS 24 related party disclosure. For this only this point number A and the last point is relevant. Other point is not the major difference. Correct. What point number A say? India's 24 disclosure as in India's 24 disclosure which conflict with the confidentiality requirement of statute or regulation are not required to meet since accounting standard cannot override the legal or regulatory requirement. We have done one point whenever disclosure of related party transaction is against the confidentiality requirement, then such disclosure is not required. We have given one example that if there is a banking company and that banking company has one KMP and KMP has opened one account in that bank, correct now. So of course the bank should not disclose the transaction of that KMP because of confidentiality required. So that transaction will not be disclosed. However, if any remuneration is paid to any KMP, that is required to disclose under Ind AS 24, if you remember. Correct? Yes, sir. One more major changes about the definition of close family member. You remember close family member? So as per Ind AS 24, close family member, close member of a family of a person has been amended to include brother, sister, father, and mother in the category of family member who may be expected to be influenced or be influenced. Means under IS 24, close family member do not include father, mother, brother, sister. Because internationally, so there is no relationship between father, mother, brother, sister. But India, we are very much emotional. We are totally attached. So in India, in the definition of close family member, they have included father, mother, brother, sister. Correct? Yes, sir. Understood? Then coming to next Ind AS 27, separate financial statement. Separate financial statement means today we'll do only the difference. Correct? Now, as per Ind AS 27, what they said, since the Company Act mandate preparation of separate financial statement, correct now, means as per India is concerned, separate financial statement is mandatory in India. However, internationally, separate financial statement is not mandatory. So what IAS 27 says, IAS 27 require to disclose the reason for preparing separate financial statement if not required by law. So under IAS 27, they require a reason कि why you are preparing separate financial statement if not required by law. Correct now. Means as per IS 27, preparation of separate financial statement is optional. But in India, preparation of separate financial statement is mandatory due to Companies Act. Therefore, such para has been removed. Therefore, such para has been removed. Understood? Yes, sir. Correct. Then one more major difference. Second point. IS 27 allow the entity to use equity method to account for investment in subsidiaries, joint venture, and associate in separate financial statement. In separate financial statement, IS 2227 allow the entity to use equity method. Means IS 27 has given option. IS 27 is for the preparation of separate financial statement. Correct. Now, if there is one associate, joint venture, or subsidiary, correct. So IS 27 says कि either you can use cost method or first let me explain you what Ind AS 27 says. Correct now. Then only you will understand. Ind AS 27 says while preparing SFS, you need to use you need to value investment in associate, joint venture, subsidiary either by using cost method or fair value method given under Ind AS 109. So they have given two options: cost or fair value method. Cost or fair value method. Correct. And when you are preparing CFS, correct, then we use equity method. This also equity method. This is the what we'll do consolidation means investment will not come. This equity method is as per 28 Ind AS 28. But under IS 27, they have given an option कि in SFS you can measure investment in associate, joint venture, subsidiary either by using cost method or fair value method, cost method or fair value method, cost method or fair value method, or equity method can be also used. Equity method. This option has been given under what? IS 27. But such option has not been given under under what? Such option has not been given under Ind AS 27. What, not required also? Because equity method is required only for consolidation purpose. Correct now? I hope you understood. The option is not given under Ind AS 27 as the equity method is not a measurement basis like cost and fair value, but is a manner of consolidation and therefore would lead to inconsistent accounting conceptually. Means I will say Ind AS is more conceptual because we chartered accountant are very much chartered accountant in India are more conceptual. Means they will do copy paste, but when they are doing copy paste they will draft it more correctly. Understood? Yes sir. Yes sir. Then coming to India's 32 financial instrument presentation, so they have given once again a, a option. What they said, IS 32 require presentation of dividend classified as an expense in the separate income statement where separate income statement is required, but this option has already removed by India's one, so this para has been deleted. So this requirement is not provided in India's 32, consequential to the removal of option regarding two statement approach in India's one. I hope you have understood. Correct. Coming to India's 33. Correct. Now, a major difference, what IS 33 says, IS 33 provided when an entity present both consolidated financial statement and separate financial statement, it may give, an option has been given, it may give EPS related information only in consolidated financial statement. Means an option has been given, if they want, they may calculate only EPS from consolidated financial statement point of view, means in separate financial statement EPS is not required. But in India, in both CFS and SFS, EPS calculation is required. So require EPS related information to be disclosed both in CFS and SFS. Understood? Yes, sir. Now, as per IS 33, what IS 33 says applies to an entity whose ordinary shares or potential ordinary shares are traded in a public market, or that files or is in the process of filing is financial statement with what, in stock exchange. Means what they said, EPS is required only for listed company or any companies which are in the process of listing. But in India, EPS is required whether it is a listed company or it is an unlisted company due to statutory requirement of Schedule 3. Therefore, the above requirement have been deleted in India's as the applicability or exemption to India's are governed by Companies Act and the rules made thereunder. Understood? Yes, sir. Correct. Understood? This is not important. This is very important. Ind AS 33, for calculating net profit or loss attributable to the equity shareholders of parent entity, they have added one para. What they have added? A paragraph has been added after para 12 on the following lines: where an item of income or expense which is otherwise required to be recognized in PL in accordance with Indian accounting standard is debited or credited to securities premium or any other reserve, the amount in respect thereof shall be deducted from profit or loss from continuing operation for the purpose of calculating basic earning per share. I have given an example of preliminary expenses. As per Companies Act, preliminary expenses can be debited to securities premium account. However, as per Ind AS or as per accounting standard, it should be charged to PL. So if you have applied the requirement of Companies Act, means if it is debited to securities premium account, for calculation of EPS, such preliminary expenses will be deducted to calculate what? To calculate profit or loss attributable to the equity shareholders of parent entity. Correct? Yes, sir. I hope you have understood. Correct? There is no such requirement, no such, no such requirement under Ind AS. Why? Because this point was not given under their Companies Act. Internationally, this point is not available only. Yes, sir. Correct? Yes, sir. Then This once again because of separate income statement you can read. This is not required. Then India's 34 interim financial reporting. So one footnote has been added in India's 34 due to legal requirement. So they have given one clarification by adding one footnote. What they have said, a footnote has been added to the para 1 of India's 34 interim financial reporting that unaudited financial result required to be prepared and presented under clause 41 of listing agreement with stock exchange is not an interim financial report as defined and under para 4 of this standard. So they have given one clarification that unaudited financial result required under clause 41 of listing agreement is not interim financial report. Therefore, for preparation of that financial result, Ind AS 34 is not applicable. I've already given, means we have also discussed same point in our class also. Yes, sir. No such requirement, no such point is given under IS 34. Correct? Yes, sir. Once again, due to the single statement, two statement, one difference will arise. Ind AS 35 allows only single statement approach on the line of Ind AS 1 presentation of financial statement, which also allows only single statement approach. IAS 34 provide option either to follow single statement approach or to follow two statement approach. I hope you have understood. Yes, sir. Correct. Now, Ind AS 36. One difference arises due to the option given under Ind AS 40. So what IS 36 says, paragraph 2F of IS 36 provide that this standard is not applied. This standard is not applied means IS 36 is not applied to the accounting for impairment of investment property that is measured at fair value. But this para is not required under Ind AS 36 means of course this is applicable to investment property which are valued under cost model. So such para has been deleted under Ind AS 36 as Ind AS 40 require only cost model for the measurement of investment property. But you need to be very careful about this point. IAS 36 is not applicable for investment property which are measured under fair value model. But IAS 36 is applicable to PP which are measured under revaluation model. Means just try to understand clarification. PP if cost model. 1 minute. Cost model IAS 36 applicable. A revaluation model IAS 36 applicable. Correct. Intangible asset cost model applicable. A revaluation model applicable. Investment property cost model applicable. Fair value model not applicable. Have you understood this point? This I am just giving a clarification for IS 36. IS 36. Have you understood this point? Correct. For India's 36, this point will not be relevant only. I hope you have understood. For India's 36, yes, sir. Yes, sir. Then coming to India's 38 intangible asset. But now this difference does not exist due to amendment in what India's 20. Correct? 1 minute. So previously, as per India's, as per IS 38, whenever any government grant whenever any non-government grant was received, so as per IS 20, there was option given either to recognize at fair value or recognize at nominal value or concessional value, as the case may be. So initially, Ind-AS 20 has given only what fair value concept, means any non-government grant received will be recognized at fair value. Because of that, there was a difference. But now under India's 20 also that option has been given, means any non-government any sorry any government grant received any government grant received for non-monetary, means which are in kind, any non-monetary government grant received, means any grant received in kind, for that we can use either fair value or nominal value or concessional value, as the case may be. Correct now. So this point is now not applicable. You can delete it. Understood? In the IS-40 already we have done what they have said. IS-40 permit both cost model and fair value model for measurement of investment property after initial recognition. Ind AS 40 permit only the cost model. Fair value model is not permitted because the unrealized gain and loss would have been required to be recognized in SOPL. Correct? The fair value of investment property in India is not reliable, and also using fair value model may lead to recognition and distribution of unrealized gain. Means as per IS 40, such gain will be also transferred to PL. So because of that, they have removed fair value model for investment property. Fair value model is different from revaluation model. When I say revaluation model, which is given under Ind AS 16 and IS 16, or when I say Ind AS 38 and IS 38. Correct now. So revaluation model means what? Fair value, then minus we do accumulated depreciation, and then we do minus accumulated impairment loss. Correct now. This was the criteria. Means even though assets are revalued, but we'll charge depreciation on that. We'll charge depreciation on that. Are we getting? But when we say fair value model means what? It will be recognized at fair value and no depreciation and impairment loss will be calculated on that. No depreciation or impairment loss will be calculated on that. I hope you have understood this point. Correct? So when we are saying fair value model is different from revaluation model. When we say revaluation model means what? When you have revalued any asset, subsequent depreciation and subsequent impairment loss will be charged. I hope you have understood this point. Correct. And in this case, fair value model, any gain or loss as per IS 40 will be transferred to PL. So any gain which is transferred to PL, can I say it become unrealized gain and available for distribution as dividend to shareholder? Therefore, such option was removed in India. I hope you have understood. Have you understood this point? Yes, sir. Correct. Yes, sir. This point also you delete because this point is not relevant because of changes under what? Lease accounting. This point also you delete. Now, Ind AS 101 first time adoption of Indian accounting standard. Of course, there will be many difference because of what? Because of first time adoption under India's first time adoption of India's in India. So changes has been done to give more relief to Indian companies. This you can read by your own. I hope this is not required. My help is not required for this. This you can read. Correct. Coming to India's 105. India's 105, or better today I think this much only because time is not permitting. But I hope you have understood whatever we have done. I hope you have understood whatever we have done. Once again, we'll carry on this point tomorrow. But have you understood all the point? We'll of course discuss in days 101 also. Don't worry. But have you understood all the difference? Please respond. Yes, sir. So for today, this much only. I hope you have understood whatever we have done. From the first class, I started teaching you. Correct now. So the balance difference will take in the next class. For today, this much only. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.